Right. All right. Good morning. Well, good afternoon for most of you. Welcome to another episode of the Wealth Management Show. I'm your host, John Paul, and today we're going to be discussing a topic as usual, along with we're going to quickly review the news, quickly review the markets, and the topic of the day is asset location. So, as we've been covering different elements of Vanguard's Advisor Alpha, sorry, let me lower the music here for a moment. As we've been covering different parts of Vanguard's Advisor Alpha study, we've been showing you guys and dissecting the different elements that lead to the biggest benefits from professionals in different specific functions. So, namely, one of the most interesting things that I pointed out to you guys was things like asset allocation. So, what investments are involved? Things like asset management. So, the rebalancing, that sort of thing. Things like what are the fund fees that you're paying are some of the lowest tier items in the hierarchy of benefits. So the highest benefit was behavioral coaching. We've done several streams on those specific topics of behavioral coaching. If you haven't seen them, please check them out. There's timestamps on the videos so you could look at what are the specific areas you want to flip through, or if you missed a certain spot, the timestamps make it very easy to seek through and find different areas of the video. So I urge you, when this stream is done, go ahead and check out the behavioral coaching segment that we did. So behavioral coaching was one of the biggest benefits. A close third place is today's topic, which is asset location. The reason we're covering the specific elements that are the higher ticket items in this Vanguard study is because they're not so known to people. So a lot of people were shocked to find that behavioral coaching was actually one of the biggest was the biggest contributor at 1.5% per year just for behavioral coaching. So the reason we covered that is to make sure that you understand it, you're receiving it, you could identify and gauge whether or not you are receiving it if you're a consumer. You could understand what you need to do yourself if you're a DIYer. You need a behavioral coach yourself, which is extremely difficult. So showing you exactly what all the elements are and covering them is the first step to educating you, elevating your knowledge, and understanding these topics so you can make sure you're receiving the benefit. So, again, today's topic is asset location. This deals with different account types, retirement account types. So Roth IRA, traditional IRA, 401k, 403b, that sort of thing. Donor advised funds we're going to talk about. What does that mean? If charitable giving is part of your plan, how you locate those assets that are going to go to someone else, very important. Offshore, the location of assets may be offshore versus domestically. That we're going to touch on that. That's very important. And at the end of the day, what are the key benefits of proper asset location? It's you get more. You get to give more. You get to leave more to your heirs. You get to have more for yourself. A lot of times it's because you're avoiding taxes or you're planning things in a smart way so you don't pay so much, and things like capital gains or income tax, that sort of thing. So the beautiful thing of asset location is it's a planning technique. It's not something where you're relying on the market to, perform for you to reach your goal. No, it's something that's part of a wealth plan. It's something that once it's included as part of a wealth plan, there's nothing else that needs to be done. You don't need to wait or hope for certain types of returns and short time frames or anything like that. It's something where you do your homework, you dot your I's, you cross your T's, and we're going to kind of explain what that means. So that's our topic of the day. Quick introduction of myself. I'm John Paul, co-founder of Rushlight Investments. I'm a private wealth manager of the firm, and what I help clients do is keep their 10,000 foot view of all of their goals right in the center of all these different elements. So the financial planning, the portfolios, the protection, the asset protection, and the estate planning, the tax planning. All these things come together to bring out proper wealth management for you. It's sort of an emergent property of all of these different elements. And that's my job, to make sure that everything's working in synchrony. It's working at a high level. We're dealing with attorneys. We're dealing with CPAs when necessary in the specific areas they're needed. also that your goals are most optimized, so that you have the highest chance of reaching your goals. So today we're going to have a bit of a normal schedule where we're going to go through the news very quickly, a couple videos to watch. We're going to go through the market watch. So we're going to pull up the platform, look at the heat map. How's the stock market doing? Are there any trends going on today? We'll look at that, and then we're going to move on to the topic that I just introduced, asset location. So with that being said, let's come over here, and we're going to go ahead and bring up the web screen so that you guys could see what's going on here with the videos. Let's lower the music as well for you guys so we could hear the videos properly. All right, here we go. Hope everyone's doing well. I think you guys are really gonna like this topic because, like I said, my favorite part about it, I'm biased because I'm a wealth manager. This is a wealth planning sort of technique. It doesn't matter if investments do X, Y, or Z. You don't have to count on anything besides the planning being properly done. And you're going to see why when we discuss it. So let's get to it here. Okay, I thought this was it's actually the first video, but I thought it was a great one. We've had questions about Bitcoin before. We've given our opinion before when our portfolio manager was on the stream with us. So let's watch this video.
It was a brilliant two-legged trade as well. We've had a bit of a pullback. Can you stay in gold, and can you stay in gold adjusted for these currencies given new weak dollar?
You have to stay in gold. I think that there's no question about it. Yes, there's competition from Bitcoin, and I think that will disappear eventually. And perhaps it's just old age on my part, wanting to be involved in the gold market in terms of gold market in euro terms, the gold market in yen terms. I think gold gets stronger across the board for a long period of time. The monetary authorities around the world, whether it's the ECB, the Fed, the Bank of Canada, the People's Bank of China, the Russian Central Bank, they're all being, they also continue to be. So that's going to drive gold prices higher, whether it's in dollar terms, euro terms, yen terms, renminbi terms at all.
We've had a raging debate across many of the themes of Bitcoin, Mr. Gartman, and one of the themes is the Bitcoin equivalency to gold.
Hey, Sebastian,
is it
good to
fair
see you,
to equivalent Bitcoin to gold?
Not really. Gold has been around for thousands of years. Bitcoin has been around for 20 years. And Bitcoin is the millennials' gold. I understand that. I get that. I will never understand Bitcoin as far as being able to buy it at 10,000, 15,000, 20,000. I shall leave that to people who are wiser, smarter, or more courageous than am I. And I fear that once at the not too distant future, the monetary authorities, the various central banks around the world are going to refuse to give up their monopoly on monetary policy. And we'll walk in one day and Bitcoin has been rendered zero. But can it go to 100,000 before then? As John Maynard Keynes once said, the market can remain illogical for longer than you or I can remain solvent. And right now, Bitcoin seems to me to be utterly illogical. Again, those who have done well in it, I wish them that they continue to do well, but it shall do so without me. I'd much rather own gold.
It's funny, a lot of the sentiments that this gentleman is voicing are similar to some of the sentiments that we voiced on the stream, where you have to understand this is something that's halved, more than halved. I think it had an 80% drop and halved, so a 50% drop within the last couple of years alone. So, sometimes people get so excited by huge gains, right? And we're always telling you to sort of focus on the risk side before you get too tempted or too seduced by huge gains. And then if the risks are acceptable and the risks that you're taking aren't going to prevent you from reaching your goal, aren't going to lead to a devastating event, then from that perspective, we go ahead and chase, the returns that you're after. Or if you're looking for a certain amount, if you want to be able to tell your friends you doubled your money with a small position, all those things could be worked into a plan, especially if they're going to make you happy. But the risks need to be in the forefront. Don't forget, again, like I'm saying, this is something that dropped almost 80%, I believe. I forgot the exact drop from the previous $20,000 a Bitcoin price, and then it's halved again since then. So you have to understand, this is obviously hugely volatile. There's risk return is a law of markets, right? So something that's highly risky obviously has the potential for high returns. It's sort of the natural order of things, right? So I liked this guy's take because there's a lot of people on both sides of the fence. Going back to our bias talk of recently, this might be confirmation bias on my end, but in my defense, it was the first video on the feed there for Bloomberg. But again, people tend to hang on to whatever opinions that support their established view. So obviously, this gentleman is voicing an opinion that's along the lines of my established view as well. So, be vigilant for that on whatever side you are, whether you're a Bitcoin lover or a Bitcoin hater, right? So keep that in mind. And it has been going crazy, but I think that's the perfect time to talk about the other side of the coin, so the risks as well, because a lot of people are talking about it now just because of the recent performance. You can see it on the graph there. Even just within December, there's been a really big break in Bitcoin. So, I just wanted to mention that to you guys. So let me see here. There's another video or two, and then we'll move on. Today, I wanted to go quickly because I want to get straight to the topic of asset location, because I think it's something that's very important, and I'm really excited to cover it. Let's watch this. It's about the US dollar and its status. So this is a great video because it's something that I've been asked about, and it's on certain people's mind, with the yen being a bigger part of the world basket and being more internationally recognized, that sort of thing.
The US dollar, in the role as the world's reserve currency, looks especially vulnerable going into 2021. Reserve currency status is based on two main items: trade volume and FX reserves. On both counts, erosion is already happening. China and Russia now conduct as much trade outside of US dollars as they do in dollars. FX reserves are still mostly held in dollars, but Russia has turned most of theirs to gold, and China is slowly reducing its stockpile. Also, the rise of cryptocurrencies and the devaluing of the dollar by the US Fed, along with other central banks not devaluing as quickly, at least in the short term, gives a little bit of a view that the US dollar could be vulnerable, although it's not likely to lose its position as the world's reserve currency in 2021. If it were to lose it, it would be a very slow process that would take years.
Right, yeah. They mentioned it won't lose it in 2021, but a slow process. I mean, that's the direction we're currently headed in, though. So it would take many years. So I guess what this gentleman's saying very softly is that that's where we're headed, but it would take years to officially lose its status. And that has implications as well. It reminds me of sort of the portfolio management points we make, where there's all these different risks out there, and if you're properly balanced at the top level, so all your risks, the way your assets are distributed, are addressing all the different risks out there, especially the risk to your goal, whether it's having to do with currencies or something like that, you're not going to worry about the US dollar losing its status. You're not going to worry about chasing returns, maybe in the last story of the Bitcoin example. So you're gonna feel confident no matter what happens in reaching your goals, and that's what we're after. At the end of the day, we have certain goals for our heirs, for philanthropic giving, for transferring to the next generation, however we can, the best way, our lifestyle and retirement, and that sort of thing. So we want certainty. We don't want to leave it up to chance, or we don't want these looming risks to be there that could totally manifest when they do. If they do, we're in a really bad spot. So that's why I'm always echoing the risk-based approach to ensure that we're going to reach your goals. So cover the risks, then we'll seek the return, and let's manage the wealth properly with the taxes, with the estate planning, with all these other things and professionals that we have on the stream and what we're talking about all the time. So let's go here. See if Robert Frank has something. He's been covering a lot the New York and Manhattan real estate sort of crisis that's going on. We saw a story where an apartment purchased in the ballpark of 30-something million was recently sold bought in 2014 and then recently sold now during the crisis for 20 something million, which was a dramatic, almost 30% decrease in the purchase price years later. So we're talking 6 years of holding it, and then he took a 30% loss in real estate. I don't really think many people expected that. If you're familiar with Manhattan real estate, it's historically been very hot, no lack of tenants, no lack of buyers or people in the city. Prices seem to just go up. Reminds me of, Miami. For those of you who are local, it's a very hot market, very rare for prices to go down, but there's always these risks. We talked again, diversification, being geographically focused in a specific area opens you up to certain risks. They may never manifest. Not many people saw the pandemic coming and the effects that it would have maybe on Manhattan real estate. But now somebody who was very focused in that geographic area is really suffering right now. They could be in a position where they have to liquidate certain assets. Just really, that's a really tough spot to be in. Could be a permanent setback. So, and then here is a survey that it kind of echoes some of the things we were talking about with our tax professional, where 2/3 of American millionaires expect higher taxes under Biden, despite there being a prediction of a gridlock in the Senate, right? So we've talked about this. We covered on the last stream. So if the president-elect wants to inflict certain tax changes, if they don't have the Senate seats required, it's going to be very difficult to do so. So although there was some dramatic tax proposals put forth, if there aren't the Senate seats to get the votes to approve it, likely won't happen. That being said, still 2/3 of American millionaires expect there to be higher taxes under Biden. So that speaks to where people's minds are at with some of these tax implications, some of the tax laws that might happen, may not happen. What should you do to manage your wealth if it does happen, or in anticipation of it happening? So what I'd like to echo when it comes to this is like, rely on professionals in this area. Get your wealth manager, get your tax professional together, and balance the risks of it not happening. What can you do now proactively? We mentioned gifting is one of the things that's relatively low risk, etc. Make sure to check out that previous live stream if you haven't seen it. So we're going to go ahead and move on here to the market watch for a moment. I wanted to show you guys what's been going on. Let's see if there's any sort of narrative that might emerge from the heat map. I'm going to go ahead and switch over here to the platform so you guys can see what I'm looking at. All right. So yeah, let's start with the heat map here. Indices, we're going to look at the S&P 500 heat map, see if there's any areas that are shining or not. So today's a down day, so naturally we're going to see a lot of red on the heat map. Bonds are up. Physical commodities, precious metals specifically, are not doing great. The indices are down. Besides the Russell 2000, which we've talked about a lot, is the smaller companies in the S&P 500. And here we see, yeah, it's kind of a mixed bag. No particular. Really, I mean, financials aren't doing so great. Communication services aren't doing so great. Apple is having a great day today. We could look into why that might be a little bit later. And Apple is such a large part of the market that it has a pretty dramatic effect on what's going on for the day. You could imagine if we maybe took out Apple and Microsoft, it looks pretty red. There's a lot of blood on the street today, right? The S&P being down just 0.25%, it would actually be considerably lower, taking out some of these big players. They're so big. They're such a big part of the market. So, yeah, here we go. Let's see here the actual chart. Here I have a chart looking at, let me put the 1 year chart. That's typically what we look on the stream. Right. So here's a full 1 year of the S&P 500. As you can see, here's the COVID crisis. We're now decently above the point where we were before coronavirus. And something that I would like to point out, when we had our portfolio manager on last, he mentioned valuations, right? And valuations are typically relative to how much maybe a company's earning. So if earnings go down, but the prices of the company stays the same, so to buy a share of the company still costs the same, but now the company earns less. The valuations are technically higher, because if you use earnings as a basis. So on aggregate, we're not back to the same employment rate that we were before coronavirus. There's a lot of economic indicators that are not looking so good as they were before coronavirus. But now stock market prices are beyond the point that they were. So that's sort of what some people are looking at as valuations having gone even higher, even though the market, when we're saying the S&P 500, let's say, is up from where it was, just a bit, valuations are considerably higher, which is interesting. But there's been talk about the vaccine, what it means, the fact that the stimulus bills on the table, what that means, how it might affect things. So all of those things are floating around now as narratives, but there doesn't seem to be a big sort of story for the day. So it's a bit of a boring Monday for the market. So I think I'm going to go ahead and move on to the topic of the day, which I'm very excited to cover with you guys. So before I cover the topic of the day, I wanted to remind you guys what we're referencing here. We're referencing the Vanguard Advisor Alpha study, okay? And let me take out the schedule so you can better see the returns, the enhancement of returns. So we covered this on a previous stream where we dissected what exactly are the functions that a professional performs for you that have the most value. And Vanguard went ahead and quantified them. So we reviewed them. Here are all the different strategies on the left, and on the right, you see the typical value that's added to a client for each and every one. So what we're going to talk about today is here, item 5, which is asset location. We covered all of these very quickly in the previous stream where the topic was Advisor Alpha. Go ahead and check it out if you haven't. And recently we covered behavioral coaching in depth because it's the biggest value. So now we're going to go down the list and we're going to talk about asset allocation. And in the future, we're going to talk about spending strategy as well. But the topic of today is asset location. So what is asset location? And I just want to be honest with you guys. The reason I wanted to cover this even before spending strategy, although the value is slightly lower, the potential value, is I just really don't think advisors, wealth managers are doing a very good job with asset location. And hear me out. I'm going to tell you guys about it, and you guys are going to probably hear some things you've never heard before. And I'm going to give you a better idea of what it means to properly take into account asset location. So let's start with what is it? Just very quickly. At the most surface level, what asset location means is you have a destined asset allocation, which is, your money's going to go here, there, X, Y, Z, all these different areas of investments to be made, assets. Some of them are physical assets. Some of them are alternative assets. Some of them are, typical stock, bonds. Ideally, you have beyond that commodities, currencies, alternatives, all these different things, right? So how are we going to place those items in all of your different accounts and all the different vehicles that exist? If we do that in a smart way, there's major benefits versus just putting them wherever we please or just replicating our overall asset allocation in each account, which happens. So there's all these different strategies where if an investment is going to kick out income and therefore is going to have income tax attached to it, right? Like let's say a bond, which certain elements of a bond are taxed at ordinary income. If you put it in a tax advantaged account, you could avoid that, and that's a big benefit. That's a typical example, the most typical example of asset location. So what it basically is just that. How are we going to structure things in terms of the planning of your entire portfolio? What different account types do you have? Are you trying to give to charity? Because then there's certain vehicles that assist with that specifically. Are you trying to give to your heirs? Then we might put certain assets specifically in certain areas to be intelligent about avoiding taxes in the future that are unnecessary. or mitigating taxes, better said, that might not be necessary to pay. So I think the key thing to understand is asset location isn't just something that sort of you talk about once and oh yeah, maybe it would be smart to do this, or maybe we should do put these in your Roth IRA because that'll make sense, or maybe we should consider putting this one in your offshore structure for XYZ reasons. Asset location, properly done, should be a deliberate part of a wealth plan. So your wealth plan that has all the elements in there, the financial planning, the tax planning, what your CPA did, what your attorneys have done, all in one place. That's what I put together for clients. A section should be asset location. So where are we going to put what and for what specific reasons to get what specific benefits? And it should be comprehensive. So it should deal with all of your assets, should have been looked at, and it should deal with all of your accounts having been looked at, and then coming up with a specific plan to decide what's going where. This is the reason we're putting this here. This is the reason we're putting this there. And all these advantages on lower taxes, easier giving, start emerging. Because at the end of the day, let's say you have an account where it's structured in a way where there might be $1 million in it, and as it's fulfilling its goal, and there might be 30% taxes put on it because it's your income rate. Let's just say, out of argument's sake, that's going to affect your 1 million becomes 700,000. If you could avoid that, maybe there's a chance that your 1 million stays 1 million even as it's accomplishing its purpose. And that's the goal of asset location in a big way. So what can be mitigated? Why? Because even if you've done the portfolios right, even if you're protecting it properly, even if you're doing all of these things, if the tax bill, let's say, ends up being exorbitantly high because you place things in the wrong accounts or in the wrong structures, it could be devastating. The difference between short-term capital gains or long-term capital gains, the difference between certain accounts where you could avoid these sorts of taxes altogether, if that could be done, doing it versus not doing it on assets that would have a big tax bill. All of these things is why it needs to be a deliberate part of your plan, not just a one-off idea, okay? So with that being said, let's talk maybe now some examples of asset location. So just to quickly run through them. If you have philanthropic goals, something called donor-advised funds is a sort of vehicle that could have massive tax implications. So let's say you have an asset that's appreciated very much. So if you were to sell it, you're going to have a capital gain. If you donate those assets to a donor advised fund, that capital gain is never realized. And the value of what you give gets to go towards your purpose of giving. And you and immediately. So you avoid that capital gain. Not just that, it could be invested to be gifted in the future. So now you've given it, and now it could grow so you could give even more. There's a litany of tax benefits. It's the reason why donor advised funds are the fastest growing giving vehicle in the United States. There's a very good reason for that, and it's structured in a way. The laws are structured in a way that there's massive benefits, especially if you, in a smart way, take into account what specific assets are we going to gift when it comes down to donor advised funds. Sorry, let me go here to the full screen so you guys could we could talk. Another example is that came into play when we spoke with our asset protection attorney on stream is offshore vehicles and offshore structures. So how do you decide what is going to go in the offshore structure among all your assets? That could have a huge impact on, certain offshore entities or areas or countries are tax havens. They're set up in a way that they're very tax friendly. So if you have maybe highly appreciating assets going to an offshore structure specifically versus other ones, you're going to maximize that benefit. So, retirement accounts, using them properly, putting the right investments in a retirement account versus a normal, traditional, non-retirement account is a very big deal, and could have a huge, huge tax benefit. versus, the typical approach of just maybe, oh, your prescription, what you should invest in is maybe 60% stocks, 40% bonds through mutual funds, which is a very traditional, typical sort of prescription. And if you just spread that out among all your accounts and don't utilize asset location properly, you miss out on a ton of wealth that ends up going away and getting taken from you through taxes. So how do you classify all these things is asset location. And the last thing I kind of wanted to cover is, what are the big benefits to this? So when you do all these things properly, it just means that you get to give more. It means that what was your goal? If it was philanthropic with the donor advised funds, it means that the charities, the foundations, the causes that you're trying to give to, you're going to end up actually giving way more than if you did this in another fashion. And that's what it's all about. It's almost, you could compare yourself to somebody else that might have even had more to give but didn't utilize these structures. You might be able to give the same or more by doing it in a proper way using asset location strategies. And that's huge. Or your heirs, right? If you use estate planning properly and tax planning properly, and things are assets are located properly, you're going to give a lot more to the next generation. Choosing what assets to gift and when deals with asset location specifically as a strategy. So all of these things need to be considered because it ends up magnifying the impact of what you have versus, minimizing the impact of what you have. Making the wrong decisions actually makes it so that whatever amount you grew to and you're trying to accomplish your goals with, whether it's your lifestyle, all these things that I'm mentioning, gets minimized by doing this improperly. Whereas if you do it properly, the effect of it actually gets maximized. You get to give more. You get to transfer more. You get to live more, a more extravagant lifestyle if that's your goal. You get to do more for yourself in retirement, and you get to better protect what you've earned. The quicker it gets eroded, the more danger you are of getting to a lower level of wealth that could compromise your lifestyle. And that's why it's so important, where you need to be considering these asset location techniques. And I keep going back to the fact that it needs to be a deliberate part of a wealth plan. It can't just be something that's done on a one-off scenario where, oh, we just created this new structure. Let's go ahead and maybe put this asset there. It would be beneficial to do that. That happens quite a bit, and you could make some good decisions like that on a one-off basis. But they need to be part of an overall plan, because as your entire wealth gets more complicated, as you get more vehicles, as you get more assets, things might start getting shifted around due to asset location reasons. So, and I always come back to, we'll come back to the browser screen. When Vanguard was talking about asset location here in this specific study, they were not delving into the massive benefits of something like a donor advised fund or offshore vehicles. They were talking about things like what I was telling you is the most traditional example of this topic, where you would put maybe bonds that would be taxed, where their income would be taxed as ordinary income. You might put them in a retirement account and save that tax, which is considerable, and it could add up to 0.75%. But they are not talking about some of these more advanced strategies that typically the high net worths that are receiving high quality wealth management receive, where something like a donor advised fund or an offshore entity are being used, where the tax benefits to there could be massive. So just take that into account. Not only is there already the potential for it to be a 0.75% a year per year, but it's in this specific study, because it would be very difficult to quantify as well. They don't include some of these things that I'm talking to you about as well that fall into this category of asset location strategies. So I want to cover in the future as well with you guys spending strategy, but I feel that might need its own sort of stream, because if we really get into that now, it's going to be difficult to finish the topic. But it's similar in a way where, just to give you guys a primer for the next stream, it's similar in a way where you have all these different asset types, you have all these different account types and structures, and instead of choosing where to put assets, what spending strategy deals with, choosing where to take assets from when money needs to be spent or capital needs to be raised. So if, to fund your lifestyle, you need X amount per year, well, where do you take that amount from specifically? In what order of accounts do we withdraw from? If you see there in parentheses, it says withdrawal order. So do we take it from a retirement account? Do we take it from a taxable account? Do we take it from a special structure that is set up? How you decide those things has a big impact on your wealth and what you retain. It has tax implications, taking from one option versus the other. If there's a more tax efficient place to take from, well, that should be higher in the pecking order when it comes to the spending strategy. So this is something that we're going to cover in the future again on future streams, but understand that it's similar in this sense, where it deals with where are your assets, but instead of placing them for the best possibility of growth or transfer and mitigating taxes, it deals with when it comes time to spend it and pull them out. Where do we pull from, in what order? And there's sort of rules and hierarchies to this, or a withdrawal order, let's say. And I'd like to point out to you guys that between the 3 topics that I'm trying to focus on, it's over 2%. Almost 3% just in the behavioral coaching, the asset location, and the spending strategy. Some of these things are a little bit lower on the totem pole mentally for a lot of people, where they might be focused on asset allocation. They might be focused on expense ratio. So how much do my funds cost? They might be focused on rebalancing. So the managing of the portfolio, as many people refer to it as. Those things are important and they do have an effect, but they pale in comparison to things like behavioral coaching, asset location, spending strategy. You have to understand these 3 right here are by far the biggest chunk of all of the strategies Vanguard covered. And the beautiful thing about them is they're planning techniques. So they don't deal with the stock market and what might happen performance-wise. Your asset allocation is going to affect your performance. Expense ratios are going to affect your performance, at least in a more predictable way. Rebalancing is going to affect your performance, but a lot of, especially rebalancing and asset allocation, what comes of it is going to highly depend on what happens in the market, which is unpredictable. Whereas behavioral coaching is something that doesn't change regardless of what happens in the market. The right places to locate your assets, which is today's topic, doesn't change regardless of what happens in the market. What's the smart way to approach your spending strategy doesn't change no matter what happens in the market. So I think that not only is that a beautiful thing to me, that they're not reliant on market performance to do their job, but they're also the biggest ticket items on this Vanguard study of functions for a wealth planner or specifically a financial advisor to accomplish for you. So yeah, I hope you guys keep this in mind, that asset location is a big deal. It seems so simple, but due to the fact that you can be taxed so much by improperly managing your wealth, improperly locating assets, it really makes it so important. And we talk a lot about the integration element on this stream, where this to me speaks to the importance of having a wealth manager that has an integrated approach. So if you are working with someone like myself that has close interaction with high quality CPAs, these sorts of planning is part of the process. The asset location and how we're going to do this in a way that minimizes the tax effect, so you can maximize your goals. You could give more, you could live more. That's a crucial component. If that sort of relationship isn't had, it makes it very difficult. There's already a lot on a wealth manager's plate in in the client interfacing, in the dealing with all these different areas of portfolio management, tax implications, all these things that you really truly need a specialized CPA to work together with them. We gave you guys an insight on now on an asset protection attorney, and how we interface and what we consider together. We gave you guys now some insight on an estate planner. What does a wealth planner and an estate planner think about when they're in the same room together and working on a client case together? And a CPA now as well, an international and domestic high net worth CPA. We had a conversation on end of year planning. Those are the sorts of conversations that need to happen, but about your specific scenario, because the answers will change, the plan will change. And then the final goal is having a cohesive plan in one place that has all of these areas hit and all of these areas listed within it. What's being done for this? What's being done for that? The asset location plan, the withdrawal order / spending strategy plan. Behavioral coaching could be touched on there. Your CPA and what they have done for your entire tax plan needs to be part of there. And it will all be in one specific location, and it's all going to be focused on meeting your goals, whatever that may be. And let me see here. We're going to check it out. Yo, Lou Corleone, thanks for coming by. Sebastian, great to see you. Anybody watching on YouTube, please come on over to our YouTube page and give us a subscribe if you haven't done so. We're going to slowly be migrating the stream over to YouTube exclusively. The stream quality is much better. The replays are all there and easily accessible with timestamps, so you could go back, review anything that you missed, very easily. So I urge you guys, please go ahead, give us a subscribe if you haven't. Hop on over to the channel. Check out some of our previous videos or streams that you've missed. We're going to keep posting on there. Our stream schedule is typically Tuesday and Thursday, but Thursday is actually Christmas Eve, so we're gonna take Thursday off, and I'll see you again in 1 week on next Tuesday, and we'll be back. We'll be back at it with you guys. It'll be the 29th. We'll be back. So keep an eye out on the YouTube channel, because we're actually gonna have some videos between now and then that aren't a live stream. So again, thank you guys for being here. This is the Wealth Management Show. My contact information will be on the screen shortly. This is a show where for an hour each stream, you get to come on here, listen to an important wealth management topic, hear my take as wealth manager. We have guests on here, CPAs, attorneys, and all these different areas that deal with wealth management. And the real goal here is elevating your knowledge, because when you don't understand some of these topics, not that you need to be an expert in it, but if you don't even understand them, it's very difficult to implement them. There ends up being a large amount of trust in your professionals that could get quite uncomfortable when you don't understand what's going on at all. Because sometimes executing these plans deals with making some big changes. We talk something like a Roth conversion deals with making a big tax payment up front when you make the conversion. Well, if you don't really know the benefit, it's going to be very uncomfortable, and you're not going to be very willing to pay that tax bill up front, or you may not be. And if that's the case, it's going to be very hard for you to take advantage of that if it's a proper strategy for you. And the same goes for all these other areas, something like a donor advised fund or offshore vehicles, or some of these asset location techniques might involve, opening a new account or forming a new structure. And if you don't understand what's going to be the benefit of it, it could be discomfort, paperwork, your time, and you won't know the benefit. It's going to make you less likely to do it. So, this is the first step, coming on here, learning about these different strategies, learning about all these areas of wealth management to elevate your knowledge and make more possible. So I'm glad you're here. Again, I'm John Paul, co-founder of Rushlight Investments. I'm a portfolio manager. I'm a private wealth manager. We also have our portfolio manager on here quite a bit as well. So I hope to catch you on another stream. Everyone have a great week. Have a happy holiday. Merry Christmas. And we'll see you again soon.